Everyone wants to retire early, so choosing the right retirement plan is essential to making that dream a reality. So a common question is, which one's better, a Roth 401k or a traditional account? If you're asking yourself the same question, don't panic. I'm here to help. And in case you didn't realize, it won't matter where in the world you are, because as long as you are a tax-paying American, you can take advantage of a 401k. Welcome back, fellow travelers and backpackers. Today, I have an incredibly important topic to discuss: the battle of the 401k accounts, Roth versus traditional. It's always been my dream to retire before the age of 40. If you're in the same boat, this video will be vital for you to make the best choice for your future going forward. I'm going to break down the differences between Roth and traditional 401k accounts and give you a comprehensive guide on the benefits and rules of withdrawal. By the end of this video, you'll have a clear understanding of which option aligns best with your retirement goals. Let's start with the basics. We'll cover everything to do with withdrawal and rules of contribution. Chapter 1. Rules of Contribution. For both types of IRAs with an employer, the deadline to be able to make the max contribution is December 31st. Think of a 401k in terms of a calendar year instead of a tax year, in this case. If you're running a 401k account yourself, this gets more tricky. I'll talk about that in another video. Setting up a self-directed 401k account changes things slightly. In this case, you have full control over where your savings are invested, meaning you can put money into more risky ventures like real estate or even crypto. This comes with added responsibility, but can be incredibly rewarding if you know what you're doing. Both Roth and traditional 401k accounts are retirement savings plans. They're accounts you put money into to grow your savings for retirement, but they have significant differences. In a traditional 401k, you contribute money before taxes are deducted from your income, which reduces your taxable income for the year. However, when you withdraw money in retirement, you pay taxes on both your contributions and the earnings. On the other hand, Roth 401k contributions are made with after-tax dollars, meaning you don't get an immediate tax break. But the big advantage comes during retirement because withdrawals, including the earnings, are tax-free. The good news is that, unlike a Roth IRA, there are no income limits on a traditional or Roth 401k. You can earn as much as you want and still protect your savings. If you're hoping to pour all of your savings into a 401k in one go, think again. The IRS put a limit to how much you can contribute to both a traditional and Roth account in a year. Luckily, that limit is quite high. You can put in $23,000 total for 2024 and $22,500 for 2023. If you're over the age of 50, catch-up contributions mean this rises to $30,500 for 2024 and $30,000 for 2023. The main sticking point here is how both plans are taxed. Either way, you're avoiding some nasty taxes, but while with a traditional 401k, you're avoiding taxes now. A Roth avoids the taxes later down the road when you actually retire. This means a Roth account is better in the long term should the percentage of your tax bracket increase when you're older, because you won't be taxed when you withdraw the money in retirement. But surely there's more to this plan, right? Let's take a closer look. Chapter 2. Rules of Withdrawal. Both accounts are great options, but you don't want to be making any mistakes when it comes to your personal savings. Let's get into the nitty-gritty of withdrawal rules for both types of 401k accounts. For a traditional 401k, you have to also contribute for 5 years before being allowed to withdraw without penalties, even if you're 59 and 1/2. However, starting at age 73, you must take required minimum distributions, RMDs. If you put in money in 2023, you can only start taking anything out without paying penalties in 2027, since the first year of contribution counts. If you put $1,000 in and that grew to $4,000, but you took it out before the waiting period is over, you'll have to pay the 10% penalty on the growth and ordinary income tax on the growth plus the original capital. In contrast, for a Roth 401k, you can withdraw both contributions and earnings tax-free after reaching age 59 and 1/2. Roth 401ks do not have required minimum distributions. However, early withdrawals are just as punishing. You will face the 10% penalty on all the growth your savings experience during its time in the account, as well as pay ordinary income tax on it. Note, however, that you are able to take out the original capital you put in without having to pay any penalties or taxes taxes since you already did that before putting the money in. Qualified withdrawals are withdrawals that can be distributed tax-free. Even the growth on earnings can be distributed tax-free. But what counts as a qualified withdrawal? They include any medical expense that exceeds 10% of your adjusted gross income, permanent disability such as paralysis or severe injury, a call to active duty if you're a member of the military, leaving your employer past the age of 55, a qualified domestic retirement order, which is usually ordered as part of a divorce. If you're taking money out of the account for anything but those reasons, you might be in trouble. There is a sneaky workaround for this. For both types of account, you can technically take a loan of up to $50,000 from yourself, then pay the 401k account in your name the market interest rate to bypass. It's legal, but can be tricky. Consult with your financial advisor before trying this. Also, only do this if you absolutely need the money right away. There's no need unless you're absolutely desperate. So that's quite a lot of information to digest. Let me break it down clearly into pros and cons so you can choose which option suits you best. Chapter 3. Benefits of a Roth 401k. So, a Roth 401k sounds very nice, but why should you go through all the effort when a traditional is ready to open right now? First, there's the obvious benefit that, as I mentioned before, a Roth 401k is more secure in the future. A traditional account saves you from taxes now, but a Roth saves you from taxes in the future. If you want to retire at 40, chances are good you're more worried about taxes increasing once you've quit work, where you're more vulnerable. Second, Roth accounts have no required minimum distributions, or RMDs. With a traditional 401k, you must start taking money out by a certain age, known as RMDs, and pay taxes on those withdrawals. The government doesn't like seeing all that untaxed money sitting there doing nothing, so it forces you to take a part of it out in your 70s. A Roth 401k doesn't have this requirement. The only time you have to take money out is after you die. In that case, you've got bigger problems on your hands. You get to protect your hard-earned money for longer. Now, technically, you can have both accounts, but that isn't optimal as you aren't able to exceed the overall limit. Meaning even if you have two, you can't go over $22,500 in total. But to maximize the benefits, I typically suggest focusing on one and maximizing them so that you also optimize your tax situation. Remember, Roth 401ks are typically set up by independents who fill out a 1099 form at the end of the year. Traditional 401ks are often offered by employers in traditional work, like if you're an employee at a company. That's all well and good, but surely there are drawbacks. A Roth account sounds almost too good to be true. Chapter 4. Benefits of traditional 401k. So, it's only fair we discuss the benefits of a traditional 401k. First is the obvious, immediate tax deductions. Contributions to a traditional 401k reduce your taxable income for the current year. If you're like me, you like to plan ahead. But being young also means you need to deal with the here and now, and oftentimes it feels a lot better taking some stress out of your financial life now rather than later. Second, you might actually end up in a lower tax bracket in retirement than you are today. If you expect to be in a lower tax bracket during retirement, a traditional 401k can save you money. When you withdraw funds, you'll pay taxes at your retirement tax rate, which might be lower than your current one. It's up to you to figure out which way the dice will fall in the future. The third is perhaps the most convincing, employer matching. Many employers offer matching contributions to traditional 401k accounts, where they pay straight into someone's traditional 401k account. This is essentially free money for your retirement. Employers typically prefer to invest in traditional accounts to avoid taxation in the immediate future. Chapter 5. Choosing the right option. Now that you're familiar with the benefits and withdrawal rules, let's talk about how to choose the right 401k option that suits your early retirement dreams best. Let's go over some quick bullet points you'll want to keep in mind when making your decision. If you're in a high tax bracket today and expect to be in a lower one when you stop working, a traditional 401k might be more advantageous due to the immediate tax deductions. On the other hand, Roth 401ks are more flexible and resistant to changes of pace. Predictability salary isn't something many young people can afford, so having a plan that's already taxed early on can offer more freedom going forward. Assess your risk tolerance and investment preferences. Roth 401ks offer tax-free withdrawals on both contributions and earnings, providing more security in retirement. But that's more the case if you're self-employed or a freelancer. If you're working a normal job, things might be different. Ask your employer if they offer matching contributions to a traditional 401k, and take advantage of the free money if they do. Just keep in mind that these contributions will be taxed upon withdrawal. If you aren't traditionally employed and fill out a 1099 income form when doing your taxes, you might want to consider a self-directed 401k account, meaning you have full control of where you invest your savings rather than letting a brokerage do it on your behalf. This lets you invest in things like real estate, gold, and even crypto, which are cut off for non-self-directed 401ks. Best of all, you can self-direct both a Roth and a traditional 401k. Personally, I use Neighbors Group to buy crypto and self-direct. For more information, make sure to subscribe, as I'll be making a more detailed video on that in the future. Or, if you want that information now, click the affiliate link in my description below. At the end of the day, I'd recommend looking into both options and potentially setting up 2 accounts. Flexibility and diversity is never a bad thing. Why not have a traditional open to avoid taxes if you're looking to save some money in the short run, and a Roth open on the side for when you're feeling more financially secure? But let's finish this off with some raw numbers. Let's say you're 20 now. Contribute $22,500 a year to your 401k account and retire at 65. If the tax rates stay the same, a Roth 401k will prove the better option, saving you over $305,000 at the end of the day. Pop your own details into a calculator and see for yourself which account fares better in the long run. Maybe you really want to take your savings to the next level, however. In that case, you can set up a self-directed Roth 401k and invest into crypto, which can make your money grow astronomically. You won't pay a single cent on that incredible growth you see throughout the years. If you have a little more appetite for risk, you might want to look into it yourself. Remember, a well-planned retirement strategy is essential to making the most of your life. You're not like most people who are looking to work for 70 years straight, then enjoy their golden years in peace. You want that peace of mind now. So keep that in mind and secure your financial future by carefully choosing the plan that works best for you. Be that more long-term or short-term oriented. Subscribe for more.